As of 11:13 a.m. Eastern Time on this Thursday, October 30th, 2025, shares of Opendoor, ticker OPN, are trading live at $8.16. That's a gain of 19 cents on the day, or about 2.38%. The stock has been active, trading in a range between $7.50 and $8.25, with a very heavy 96 million shares already changing hands. Now, seeing a 2.4% intraday move on your screen for a stock like this might seem like just another day, but this small green candle is a mask. It hides one of the most violent and contradictory stories playing out in the entire market. The expectation is that you're looking at a busted real estate company, a high-flying pandemic-era name that got crushed by interest rates. The reality is that Opendoor has become a battleground, a high-stakes poker game between some of the largest institutional players in the world, and the company's Q3 earnings, due in just 1 week on November 6th, could be the card that flips the entire table. The common belief is that Opendoor is a simple house flipper, a casualty of the Federal Reserve. Its business model, buying homes with cash, is seen as terminally flawed when mortgage rates are high and home prices are uncertain. This isn't Tesla stock, with a narrative of AI and robo-taxis, nor is it Nvidia stock, riding a wave of data center expansion. The popular narrative is that Opendoor is a high-risk gamble, a meme stock that has inexplicably risen over 300% this year on pure speculation. And many analysts agree. The consensus rating is a sell, with price targets that are, frankly, insulting. We just saw one analyst group raise its target, but only to $1.78. Another has a target of $1.36. With the stock trading over $8, the analyst community is essentially telling the market it is 500% wrong. But the reality, the thing that forces us to look closer, is that while the public-facing analysts are screaming sell, some of the most sophisticated quant hedge funds on the planet are quietly building massive positions. This isn't just retail speculation on the Robinhood app. According to the latest filings, quant giant 2 Sigma Advisors has massively increased its stake, going from 1.8 million shares to over 13 million. Qube Research and Technologies, another major quant firm, opened a brand new position, buying 12.5 million shares out of nowhere. And perhaps most notably, Jane Street Group Limited, a massive and notoriously quiet trading firm, recently disclosed a 5.9% stake in the company, holding over 44 million shares. These firms don't make emotional bets. They don't care about the meme stock narrative. Their algorithms have identified something. At the exact same time, the old guard, passive institutional money is running for the exits. The Vanguard group has dumped nearly 20 million shares. BlackRock has slashed its position by 70%, selling over 35 million shares. Rowe Price has also reduced its holdings significantly. This is the central conflict. The index funds and traditional asset managers are selling, confirming the busted iBuyer expectation. The high-frequency, algorithm-driven quant funds are buying, betting on a completely different reality. The retail investor, perhaps using SoFi Invest or a Fidelity brokerage account, is caught right in the middle. This stock is a powder keg, and the recent price action shows it. It's had over 96 days in the last year, with a move greater than 5%. This is the definition of volatility. This entire setup is coming to a head next week with the Q3 earnings report. The options market, which you can track on platforms like Interactive Brokers, is pricing in a massive swing, an implied move of nearly 15% in either direction based on the November 6th report. This will be the first full quarter report under the new leadership team. Back in September, the company went through a massive shakeup. A new CEO, Kaz Nejatian, was brought in from Shopify. The co-founders, Keith Rabois and Eric Wu, rejoined the board of directors. This isn't just a minor change. It signals a complete strategic pivot. The expectation was that Opendoor would live and die by its ability to flip houses. The new reality the company is trying to sell is a shift away from that capital-intensive model. They are pushing an AI-first and agent-led platform, a capital-light strategy to use their data and cash offer engine to partner with real estate agents rather than trying to do everything on their own balance sheet. This is the new bull case, that Opendoor is transforming from a capital-intensive financial company into a high-margin tech platform. The problem is, their last guidance was terrible. When they reported a surprising positive adjusted EBITDA in Q2, they immediately warned that Q3 would see a significant revenue decline and a return to negative EBITDA. The question for next week is simple. Did they underpromise so they could over-deliver? Or is the busted iBuyer narrative correct after all? Let's quickly review what this company actually does because it's central to the risk. Opendoor is the pioneer of iBuying. The model is straightforward. A homeowner goes to Opendoor's website, types in their address, and gets an all-cash offer for their home, often in minutes. If they accept, Opendoor buys the house, performs some minor repairs, and then tries to flip it on the open market for a profit. The entire business lives and dies on the spread, and their gross margin is razor-thin at around 8%. This is not Apple stock with its massive hardware margins. An 8% gross margin before paying for all its engineers, marketing, and corporate overhead is an incredibly tough business. When interest rates were at 0 and home prices only went up, the model worked. When rates shot up, the model broke. They were caught holding billions of inventory that was suddenly worth less than what they paid. This is the core risk, and it's why the stock is so tethered to macroeconomic news. A strong housing report like the one we got in September sends the stock flying. A hawkish word from the Fed sends it plummeting. This is not a stock for an intelligent portfolio or a set-it-and-forget-it Schwab Intelligent Portfolios account. This is a high-contact sport for those doing self-investing with a very high tolerance for risk. Many are looking for investment help to navigate this, but the truth is, the experts are just as divided as the retail crowd. So what is the path forward? The expectation is that for Opendoor to succeed, we need the Fed to cut rates, which would lower mortgage rates and bring the housing market roaring back. The reality is that this is far too simplistic. The company's biggest risk, as one analyst put it, isn't the housing market. It's the company's own terrible gross margins. They have to prove they can be profitable in any market. The new AI-first agent partnership model is their attempt to do that. The bull case is that the new CEO strips the company down, leverages its data pricing engine as a service, and creates a high-margin capital-light business. The bear case is that this is a desperate Hail Mary, that the agent partnership model doesn't scale, and that the company is, at its core, a high-risk leveraged financial company with a high debt-to-equity ratio of 3.46, and it's running out of time. The quant funds like Jane Street and 2 Sigma might be betting on a short-term anomaly, an earnings beat, or that their algorithms simply see a pattern the rest of us don't. The long-term institutions like BlackRock and Vanguard, who manage Fidelity mutual funds and Fidelity ETFs for millions, are making the opposite bet, that in the long run, the fundamentals are broken. This is a stock where you can open your Fidelity mobile app or your Robinhood stock trading platform and see a price, but that price represents a fundamental disagreement about the company's very existence. It's a tough environment, and this stock is at the center of the storm. Comment below with your cost basis on Open. Are you holding bags from the highs, or did you get in at these multi-year lows? In the end, Opendoor presents one of the clearest cases of expectation versus reality in the market today. The expectation is a simple, high-growth tech disruptor for real estate. The reality is a capital-intensive, high-risk financial company that is completely tethered to the macroeconomic environment. The price you see on your Fidelity mobile app or your Robinhood stock trading screen is a consensus of that fear and that faint hope. The question is whether their data science is good enough to survive what's coming. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.